Good evening, everyone. This is Henry Gambell with SimplerOptions.com, and in today's free video I wanted to take a look at Facebook. So a couple of things going on with this pattern, and the main thing that I'm going to focus on today is just the idea that this is really the bullish campaign swing that we've seen from this post-earnings sell-off. So you have the earnings, you get the big drop after that to come back and fill the gap, and this is all the action that you've seen past that. Okay, easy enough. I feel like that's enough data to point out these swings and to give us some analysis that we can use heading into tomorrow. I like looking at it, and you can do this very basic by just taking something like a trend line and saying from previous swing high to swing low is going to give us, a 6 to 5 bar correction that equaled about $6.15. Well, we can drop that level, and this is just another way of doing, very similar type of work, but then duplicate this drawing, which will allow you to drag it back over, and then if we place it at this swing high, notice the relationship to this decline as to what we've seen here, and it's just based off the idea that what happened after that decline? Well, you went on to tack on another, solid $16 a share price. Not quite that much. I was looking at the wrong price, but it was at least $10. It was a very healthy move. So from 110, could we go up into 120? That'd be very nice, symmetrical, and it'd make a lot of sense. So I don't know if it's going to happen, but if it drops down there into that level tomorrow, I think there's 3 ways you want to take a look at playing it. The first of which, and the one that will be the most straightforward, but still somewhat aggressive, is going to be the sell the put spread that expires this week. There's not a ton of premium in these, as the volatility has been kind of low, but when it drops, you should see that perk up. Using 110, I think will be a decent strike to try and defend against. The other, that I think is still a very simple approach, though this one is very risky, is to come out and buy call options in the week of earnings. So you can use the earnings date to help confirm, but generally speaking, you're going to see the jump in implied volatility that tells you where you need to be, and on that weakness, you should be able to come in and buy some of these either at the money or out of the money a little bit cheaper. And you say, well, why are you going to buy an out of the money call? Well, I would like to see that this implied volatility continues to go up, and then if I can also match that with being correct on direction or delta, well, then that's where that trade would work out. So pretty simple, but a little bit risky. And then the next one that I look at, which might be intriguing to some people, is the idea that if it drops down into 110, I'd like to benefit from being able to, basically if the underlying trades sideways or move higher, that's where I'd like to do the best with it. And that's where these unbalanced flies come in handy. So doing something like this, I'm usually going to price them out $3 or 3 strikes wide to begin with. The 113, 110, 107. If I can get that somewhere around a 50-cent credit tomorrow, I think that'll be a nice position to manage over the course of the next 10 days, give me some nice theta decay, and then if we decide to resume the bull trend from that point, I will still take in that credit. So those are a couple of ways to look at playing Facebook. I think that ticker will absolutely be in play tomorrow, and I hope you found that helpful. Have a great night, and I will talk to you at the next free video.